It really was a week largely dominated by tax reform, though. The general consensus has been that it's going to be great for stocks if it eventually passes. But my next guest says we could still see a short-term sell-off. Bank of America's Global Wealth and Investment Management Division Chief Investment Officer Chris Hyzy joins us right now. Chris, it's good to see you.
Good to see you, Maria.
Thank you so much for joining us. So what's your take once, in fact, the tax plan moves forward? I mean, you buy on the rumor, you sell on the news. What do you think?
Well, I think you have to reposition yourself for upward trending markets, at least for the next couple of years. So any kind of mini sell-off you get here is usually just an exhale off of earnings. Earnings have been great. We've had a profit recession in 14 and 15. We had a little bit of movement up in 16 and 17. It's been all about the profit cycle to the point where it's 3 to 4 times GDP growth. I mean, 3 to 4 times GDP growth is what earnings growth has been, particularly in the United States, not to mention what's happening overseas. So the game theory that's going on geopolitically around the world, plus what's going on in Washington politics to try to get past a tax reform or tax cut bill, could cause a mini sell-off, which is what our expectation is heading into December, and then ultimately in December you get that move back up again.
So you're a bull over the long term.
Absolutely.
Yeah.
The big bedrock of being a bull right now is not just feel good about the upward trajectory of markets, because at the end of the day, there has to be a catalyst to move asset prices up. And that happens to be the paradox of low interest rates. Low interest rates are feeding on itself. And as long as you have disinflationary forces out there, demographics, the world is aging, et cetera, if you get higher credit growth than you get GDP growth, it feeds on itself. And you get the feedback loop back into corporate profits. And that's what we expect over the long haul.
Corporate profits were strong in the third quarter, better than expected. Again, 7% higher or something for the third quarter, right?
Absolutely. And it's pretty much across the board. And I know everyone's focused on particularly one corner of the technology spectrum, but it's across all sectors. Innovation is taking over where the previous innovation cycle left off. This time around, it's pushing prices down. It's not necessarily feeding into productivity. That's the second half of the wave where CapEx starts to come through, in our opinion.
Yeah, I'm going to ask Robert Kaplan about productivity coming up. President of the Federal Reserve of Dallas, where do you want to be invested right now? I mean, what sector should we be exposed to?
Everyone's focused still on the United States for a variety of reasons. They have what's going on fiscally, also the fact that the Fed really is leading other central banks into a so-called roll-off phase. But the real story is the emerging markets still. They have outperformed this year, first time in 5 or 6 years. They got out of bear markets. They have a profit cycle. They have a vibrant middle class, particularly in Asia. China is still moving towards a service economy, now over 50% from fixed asset investment. So the real story is overseas, better valuations, better earnings growth overall, and still haven't fixed their credit backdrop, particularly in Europe in the banking system. So they have a ways to go there. That doesn't mean that if the U.S. starts to roll over in their stock market, it's not going to be exported overseas. It's likely the case. However, from a valuation, earnings growth perspective and where they are in the cycle, it's still non-U.S. equities.
So you like EM, emerging markets in Europe, better than the U.S. right now?
Yes, and Japan as well. I mean, Japan is really, forget what's going on with the Bank of Japan for a second, but think about the shareholder activism that really has hit that country for the first time ever.
Well, that's really interesting. Yeah. So do you want to buy individual companies within these markets, or do ETFs, or how do you do it?
I think it's a combination of both. I mean, active management right now on a collective basis has much lower correlations working for itself. So it's actually easier as an active manager to outperform than the recent past. But a hybrid approach, in our opinion, is a more effective way to look at investing nowadays. It keeps costs low. You have exposure where you need it, where your information ratio, where your ability to outperform isn't as great, and then you build around that with active management.
Do you think the tax plan goes through?
Yes. Yes.
Okay. At this point, there's the expectation that this is going to happen.
Yeah.
If it doesn't happen, what happens to markets?
You know, what's interesting about that, if you put a collective basket of companies, high-tax companies, together, and you aggregate it, and you see whether or not that has outperformed the broader market, the answer is no, it really hasn't. So when people say that the tax plan is in the market, it's in the return of the market, it really isn't from our perspective. And small caps haven't outperformed, which would be the bigger beneficiaries of a tax plan. So you get an exhale. I think you get an exhale, 4, 5, 6% pullback, which is a buying opportunity.
Really great insights from you always, Chris. Thanks so much.
Thanks, Maria.
Good to see you. Chris Hyzy joining us there.